Hey everyone, over the last 2 to 3 decades, the Indian IT sector has been one of the biggest wealth creators in the country. Companies like TCS, Infosys, HCL, and Wipro weren't just software service provider. They were compounding machines. Stable careers, massive cash flows, regular dividends, and consistent growth. These firms defined India's dominance in global tech services. But now, something is changing. Major IT companies have reported weak revenue growth, deal pipelines are slowing, fresh hirings are at multi-year lows, and margins are under pressure. And at the center of the shift is a question that is worrying both investors and professionals. With the rise of AI, is this the end of the global era for Indian IT? Will artificial intelligence kill the Indian IT industry? Alright, let's discuss this. Okay, before we start, there's a lot of confusion on latest Trump tariff of 25% on India. So let me make it very clear that this tariff has no impact on IT sector. Now let's first start with the results, because ultimately stock price movement is linked with the business performance, and then we'll deep dive into the performance. So if you look at the top IT service providers, obviously TCS is the largest company. Now if you look at its trailing 12-month revenue and profit, revenue growth is just 5% and net profit growth is just 4%. Clearly there's a massive slowdown as compared to long-term revenue and net profit growth. Then if you look at its latest result, sales growth is just 1% and net profit is only 6%. In fact, recently it has declared layoff of 12,000 employees, which is around 2% of its workforce. Then if you look at Infosys trailing 12-month revenue and profits, revenue growth is just 7% and net profit growth is just 2%. Again, much lower than historical average. Also in latest Q1 result, its sales are up by 8% year on year and net profit is up by 9% year on year. HCL also has a similar story with 7% revenue growth in trailing 12 month and 3% net profit growth. And Q1 results are also weak with 8% revenue growth and minus 10% net profit growth year on year. As a result, these IT companies are underperforming for a long time. TCS share price is down 35% from the highs in last 1 year and now trading at below 3 years level. Infosys share price is down 26% from the highs in last 1 year and has not generated any return in last 3 years. HCL share price is down 27% from 1 year high. The big question here is this slowdown due to AI or is there any other issue? And if the slowdown is due to AI, is this a permanent disruption or just a reset? So if we take the first question, I think the current slowdown in Indian IT sector is due to two factors. First is obviously AI. Now it's important to understand how AI is impacting Indian IT sector. Basically, Gen AI is driving significant efficiency across software development and maintenance, especially in areas like coding, testing, and debugging. And this segment contributes around 35 to 40% of IT sector revenue. So even if partial automation happens from Gen AI, it poses a meaningful headwind. IT companies have also acknowledged that Gen AI-led productivity is translating into commercial pressure. Clients now want fewer engineers, more automation, and outcome-based contracts. And that's where IT companies' headcount-based billing model is facing pressure. But AI is not the only factor behind this slowdown. Second factor is weak global macros. US and Europe, that contribute over 70 to 80% of Indian IT revenue, are facing slowdown, inflation, and high interest rates. As a result, global companies have cut discretionary tech spending. Even large BFSI and retail clients, that is the key vertical for IT, are delaying or renegotiating deals. So I think the current slowdown in large cap IT companies is due to both macro level challenges that has cut down or delayed the IT spending, plus due to AI, there is margin pressure where clients are looking for more productivity with fewer resources. Now next question is AI going to be a permanent disruptor or just a reset? So first of all, let's be very clear, this is not the first time IT sector has faced headwinds. During 2008-9 global financial crisis, the IT sector witnessed massive degrowth due to macro challenges in US and Europe. Then technology is always evolving. During 2015-16, IT sector witnessed automation and RPA wave where low-end roles faced pressure as clients embraced bots and automation tool to reduce headcount. Then 2018-19 witnessed digital transformation shift where clients moved from legacy IT to cloud, AI, and data-driven solution. But IT companies have always evolved and adapted to these changes. In fact, these technology shifts resulted in massive business for the IT sector. I think the same opportunity exists with AI. But the pace of change is now much faster. Another challenge this time is, unlike previous tech transformation where clients were quick to adapt to changes and budget allocation, this time clients are cautious with Gen AI adoption. Clients are experimenting, but large-scale rollouts are limited and traditional programs continue to get rationalized or delayed. As a result, the deflation in legacy services is not being offset with Gen AI, at least not yet. Having said this, top Indian IT companies are already started pivoting to Gen AI. Infosys, for example, has launched Top S, its Gen AI platform where it is reskilling more than 40,000 employees. Wipro has announced $1 billion Gen AI investment and global AI labs. TCS is building internal AI accelerator, working with BFSI client on Gen AI pilots. HCL has partnered with cloud providers to build AI delivery model. But here is the reality. Revenue from Gen AI is still less than 1% for most firms. Let's be honest, it's early days. Another interesting take is, look at some mid-cap companies like Persistence and Coforge. Even in such environment, they are growing at a much faster rate. Persistent revenue has grown 22% in trailing 12 months, net profit growth is 30%. In latest Q1 result, its revenue is up by 22% year on year, net profit is up by 39%. Likewise, Coforge trailing 12-month revenue has grown at 45% and net profit has grown at 23% year on year. In latest Q1, revenue jumped by 56% and net profits are up by 88% year on year. So it's not that AI is killing the IT sector. It's more about adoption. Companies that would adapt faster to AI would do better. Midcap IT companies like Persistent and Coforge are currently outpacing the growth of TCS or Infosys because they are focused, agile, and less weighted down by legacy revenue. For instance, Persistent is deeply focused on cloud, digital engineering, and healthcare tech. Coforge specializes in travel, BFSI, and digital transformation services. They are less dependent on legacy services, unlike TCS or Infosys that still earn a large chunk from traditional IT contracts. Then second reason is, it's easier for a 20,000, 30,000 crore market cap company to pivot quicker than a 10 lakh crore market cap giant. Mid-cap companies can take bolder bets and experiment faster with Gen AI or cloud-based delivery. And third reason is base effect. For a company that is doing 2,000 crore revenue, it's easier to grow at 15-20% rate as compared to a company that is doing 15 to 20,000 crore revenue. Having said this, it does not mean the large cap companies are done. They are just navigating a much bigger ship. And when it turns with scale. Then another important aspect we should look at is valuation. During COVID period, IT sector witnessed a massive bull run. As a result, the valuation in this space zoomed a lot as compared to the historical average. For instance, TCS that used to trade below PE of 20 before COVID started trading much above historical PE. And now, with the correction, PE is at below historical median. Same goes with Infosys. It used to trade below PE of 22, but post-COVID, valuations became high and now it has also reverted to mean. If you look at mid-cap companies like Persistent, it has witnessed a massive re-rating where PE jumped from below levels of 20 before COVID to touch highs of 70, 80. Obviously, such valuations are not sustainable unless company is growing at a very fast pace and would continue to do so. So Persistent has also seen correction in share price and now PE is at levels of 50, which is still on the higher side. Likewise, Coforge used to trade at very low PE multiple and now the valuations are way above the historical median. Basically, the problem is large cap companies are witnessing slowdown and mid cap companies like Persistent and Coforge that are still doing very well and growing at a much faster rate, but they command a very high valuation. Hence, I don't see any key trigger for the IT sector in the near term. For IT sector to do well, there has to be an uptick in growth. And for that, we need to keep a close eye on quarter performance. By the way, I keep a close eye on more than 200 quarter results in an Excel sheet and discuss it in my exclusive weekly video series that also include my own investment strategy. Now that we are in Q1 FY26 result season, it really helps in identifying the investment opportunities. But this series is strictly for long-term investors. Last, if we discuss companies like Newgen that are not traditional IT service provider, but they are product-based software companies. So Newgen has generated exceptional return in last 2-3 years. However, there's a sharp 50% plus correction in last 8 months. The key reason here is valuation. 3 years ago, Newgen was trading at a PE of around 15-16. With huge valuation re-rating, it touched high PE of 80. Again, that is not a sustainable valuation and hence it witnessed valuation de-rating. Its quarter results were also weak that further fueled the correction. Having said this, Newgen has managed to grow its profit at 33% CAGR rate in last 5 years and 24% CAGR rate in last 3 years. Just one bad result does not mean Newgen is a bad company. Yes, management has also acknowledged that there's a pain where deal sizes have become smaller and there is some level of delay in decision making. But the bigger reason for more than 50% correction is due to crazy valuation. Now that P is around 36-37, it's worth keeping a close eye. Anything between 30 to 35 PE would be worth considering Newgen for long term. So to conclude, will AI kill Indian IT? Not at all. The Indian IT sector isn't dying, it's evolving. Yes, we are going through a phase of pain, clients are cautious, legacy models are under pressure, and AI is disrupting traditional roles. But this is not the first transformation the industry has seen, and it won't be the last. Just like the digital wave, cloud migration, and automation, AI is a shift that will reward the players who adapt faster. The headcount-based model that made Indian IT successful for 20 years is no longer enough. Client wants outcome, and employees need to do more than just code. They need to solve problems using tools like AI. On the other side, midcap IT companies like Persistent and Coforge are already showing that agility and focus can drive growth, even in uncertain times. Large players like TCS, Infosys, HCL are also building their AI engines, but it will take time to reflect in numbers. At the moment, from an investor lens, you need to stay balanced. Don't chase hype, don't assume legacy firms are finished. Focus on earning growth, realistic valuation, and AI integration. Post-COVID boom, yes, valuations got re-rated for most of the IT companies. But this current period of pain has resulted in valuation reverting to the mean. That's a good news. Now, only important factor is growth. If IT sector can start showing growth, it will bounce back. It may not happen immediately. IT sector may continue to test patience and share price may continue to face pressure. But when the next growth cycle would begin, you will get a good entry point from the valuation perspective. We'll keep a close eye. So whether you are an investor or a professional, the opportunity is still massive. But only if you are willing to adapt, learn and stay patient. IT sector is definitely not in momentum at the moment, but with this fall in valuation, it should be a good contra bet if the growth comes back. If you find this video useful, do share it within your circle. And what do you think? Is IT sector dead or just a reset? Drop a comment. I would love to hear your thoughts. Thank you for watching this video. I'll see you next one. Till then, take care.